that will now become very important. Benjamin Cavender, the China Market Research Group, from China Market Research Group, joins us with his thoughts on what MSCI is telling us. Good morning, Benjamin. Thank you very much for joining in. The MSCI has raised issues of capital mobility and quota allocation, among other things, as reasons why it is not yet including too much of the A shares in the index. How do you think things are going to proceed from here on? Do we expect that 5% will be included next year?
You know, I think MSCI has clearly signaled that they're interested in adding the A shares, so I think we're absolutely moving that direction. We're kind of in the final run here where the final cleanup and concerns sort of get taken care of. I think the big issue right now is quotas allocated to foreign investors right now are still currently too small. Right now, quotas only account for about 5% weighting for the emerging markets index, whereas if the entire A-share market were added to the MSCI, that weighting would jump up to close to 25%. So basically what we're looking to see going forward is quotas getting a whole lot larger and making it easier for foreign companies to get their money in and out of the market.
What's your sense of, I'm sure you're looking at the way China is progressing on these matters. Is China poised to increase foreign participation beyond this 5% very rapidly?
It seems like they're moving in that direction, and maybe more quickly than people might think. Last year we had the Shanghai-Hong Kong Stock Connect program open up. Looking at the first quarter of this year, we're going to see the Shenzhen market open up probably in a similar way. Since the last year, they've increased quotas about 50%, so they're clearly making steps to move in that direction. The question is, how long is it going to take for them to kind of get the rest of the way? And I wouldn't be surprised if we saw that happen even within the next sort of 6 to 8 months. And if that does, I could also see MSCI saying, well, look, you know what, they've taken the steps they need to take. We're going to add the A shares.
Benjamin, hi, morning. So do you see China continue to outperform markets like India? And what do you think could be the extent of the fund flows that move into the China A shares once they get included?
Yeah, this is an interesting question. I mean, looking at the A share market, we've seen a tremendous run-up over the last year. You know, Shanghai is trading at sort of 20 times earnings, Shenzhen at close to 60 times earnings. So in some sense, shares are not really undervalued in China anymore. So I think from an institutional investor perspective, they might be initially cautious, but if they have to track emerging markets indexes, and China is included, they're going to have to reweight towards China. I could see that leading to anywhere from $20 billion to $50 billion US dollars kind of coming into the China market if the quotas are relaxed. So it's a lot of money.
Yes, exactly, and that was my question. You know, China is already battling a slowdown internally, or at least even mildly encouraging it. If you have this kind of money coming in, there is a problem of Chinese yuan appreciation. So do you think China, for separate reasons, could go slow on allowing so much of money to come in one shot?
You know, I could see them trying to kind of slow things down a little bit to control the situation. But at the end of the day, I think they probably have more to gain from opening the markets up. By bringing in institutional investors, they'll probably be able to stabilize the A-share market to some extent. I think one of the issues we have is the market's really driven right now by retail investors who are essentially sort of gambling on what they think is going to happen in the future. So bringing in some professional investors could actually calm things down.
Right. Finally, what matters to us in India? Do you see over the next 12 months chances of money that would otherwise have come to India going to China, being the more preferred market in many people's pecking order?
I think the issue is we might see some reweighting towards China simply because larger exchange-traded funds are trying to sort of match or benchmark the MSCI index. However, purely from an investor standpoint, I think investors are still going to be very interested in India, and perhaps in some ways even more interested in India just because the growth story there is a bit more impressive than it is in China right now.
So you reckon that the $20 to $50 billion that could enter the Chinese market will be a lot of local money out of Hong Kong, etc., or do you think that some amount of money from India could move into China as well?
I think initially it'll probably be local money as well as sort of some of the major international funds coming out of Europe and the U.S. that are trying to sort of reallocate their portfolios. Some of that money might be money that was otherwise earmarked for India, but I think probably that would be a very small fraction of that capital flow.
All
right. Thanks, Benjamin, for joining us and giving us your view. So far, Indian investors should not be worried, but eventually in the next 6 to 8 months, when the China A shares get added, then there could be a huge amount of fund flow into the Chinese market. But let's take a look